day, everyone, and thank you for joining us once again here at Seafried and Brew for our economic briefing. For this week's briefing, we're going to review over credit risk, and that's the focus that we're going to put on this briefing is credit. And that's because we could potentially be entering into a credit cycle where we start to see higher levels of non-current loans and charge-offs. So we want to take a time today to review over historically the experience that the U.S. commercial bank industry has seen in terms of non-current loans and charge-offs, as well as a framework that you can utilize to evaluate your potential credit risk and your credit shock to capital in these different scenarios. So let's look at the overall level of non-current loans over history. And you can see we chart going back to 1989. And we have several peaks in here. The most recent would be that Great Recession going back to 2009. And we topped out a little over 5.5% of non-current loans to total loans. And then we continue to come down throughout this time period over the past 10 years. We never really reached back down to the levels we saw prior to the Great Recession, but we did make a lot of headway. In fact, we're just under 1% at the end of 2019. Now, we can't just look at the overall level of non-current loans. We also have to take into consideration those net charge-offs. So we charted that as well, going back to 1969, though, with the level of net charge-offs to total loans, which are these blue bars here. And we can see we've had a number of different spikes to varying degrees. Back in the mid-70s, we had the early 90s, late 80s. After that recession, we saw that peak. We had the 2001 recession. We saw net charge-offs peak up there as well, but nothing compares to what we saw back in 2008, where we saw the net charge-offs in aggregate for the U.S. commercial banks in excess of 2.5%. So we saw 2 years of extreme levels of charge-offs during that time period. And we can see that's reflected also in the overall level of the allowance of loan losses. Since then, we have come back down just under 0.5% for the last quarter in 2019. So we need to take this into consideration when we start looking at our loan portfolios and trying to evaluate the potential impact to capital that this credit cycle might have. So when we look at the U.S. commercial banks in a more recent time period, going back to 2008, we look at just the overall charge-offs to total loans. So we're not doing the net, we're just looking at what was charged off. And we can see back in that 2009-2010 time period, we were just about at that 3% level. And that's the framework we want to look at in order to evaluate our current circumstances. So we look at the overall level, but we also need to take into consideration the structure of our loan portfolios. So here we trend back of the different sectors in the loan portfolio in terms of the overall charge-off rates for each sector. And notice the highest one here, looking at this green number at 12% during that time period, that would be charge-offs on credit cards. So we know those are the most risky because they are truly unsecured, and we see that reflected in the level of charge-offs back in that time frame. So when we look back into history between 2008 and 2019, we see these different maximum charge-off rates per sector. And we can utilize these in terms of applying the charge-off rates to our current loan portfolio and come up with a fairly good estimate of potential risk and the risk to capital. So overall, we look at the maximum amount in any one given year, as well as the average rate throughout that time period. And by combining these two numbers, we come up with a charge-off rate for a scenario. So we do this with a lot of institutions where we look at their structure of their loan portfolio, and then we take into consideration these historical loss rates during those time periods. And from that, we can construct an impact to capital. So how do these credit charge-offs impact the overall level of capital, and how much can the bank withstand in charge-offs and yet maintain a well-capital level? And we look at the overall, if we take this sample bank, apply that historical scenario, we find that that bank would have $4 million in net charge-offs with a 4.19% to total loans. Factoring in the potential earnings during that time period, we come down and we see that because they're already well capitalized, they can withstand this charge-offs, this level of charge-offs, and still remain well capitalized. In fact, when we look at this scenario, even their total capital ratio at the end comes down to 18.4%. So this is a highly capitalized institution. But we take it a step further and want to see what's the maximum they can charge off while still remaining well capitalized. So we do that calculation. That comes up to be about 13 million, or 13% of their loan portfolio, and we can see how that comes out at the bottom, where their total capital ratio is at 10%, just at that well-capitalized level. And that's how we want to look at our loan portfolios as we try to determine the potential risk to our capital. But we have to take a step back and remember that we don't only have risk in the loans, but we also have risk in our investment portfolio. So that's, if you're investing in mortgage backs or CMOs or CMBSs or commercial credits, they all have risk, as well as the municipal portfolio. And at Seafried & Brew, we do have a municipal credit ratings that we utilize for our customers, in which we look at the municipal bonds on a individual level at the issuer. So we're looking at the underlying, making sure that the financials are strong in terms of the financial management and the overall performance. And then we give each municipality a rating. And it's important to do that because you want to understand what that credit risk is in that municipal portfolio. Now, with the COVID, we had to take that a step further. And back in March, we issued a letter in how we were going to approach this new risk that jumped out. And although we did see over the course of time municipalities continue to get stronger in their financial management and performance, we realize and recognize that there is a potential risk to these municipalities because of all the closures and the health concerns in some of these areas. So what we did is we defined 4 levels of risk within our framework. And these are the levels. A level 3 would indicate that there is a significant short-term risk to earnings and credit in those bonds, in those municipalities or those issuers. And then we look at level 2 and level 1, and then limited risk. So we have this framework in place which we utilize when we're looking at our municipal portfolios for our institutions. And it's important to go through your portfolio and identify what could potentially have risk and how much risk are you taking on because of the COVID. If you want to learn a little more about the risk levels, you can look at our website. We have a link here. Get on there, read our little article, and we also have a video, a more extensive video talking about the COVID risk levels that we've implemented and how you can obtain those for your portfolio. Well, that's what we have for you this week. We look forward to talking to you again in the future. I will be out next week, so we will not have a video, but we will return in July. Have a great week, everyone.